Joining us now via phone, Mike Mayo, behind the call, Wells Fargo senior banking analyst. Mike, why did you make this call? Is it the weakness we've seen in capital markets?
Yeah, the equity market's been pretty shut in the first quarter, and it's just about relaying this to our estimates for the quarter. But I'd say for each J.P. Morgan and Morgan Stanley, there's a little bit extra. And the big news for J.P. Morgan today is Jamie Dimon's CEO letter came out. And I would say I'm convinced on the direction the company is taking, but not the details. And Jamie Dimon doesn't disappoint. He says, change or die. And they're changing. It's kind of Jamie Dimon against the world. He's talking about competition, not just from banks, but from non-banks, neobanks, and shadow banks, which are twice as large as the U.S. banks. Remember, these are all non-regulated competitors. So J.P. Morgan is spending, buying, and paying whatever it takes to compete. On offense, they say they want to be an international digital consumer bank. On defense, they say they want to make the ship, quote, tip-top shape, unquote. But wow, they still will have likely the greatest expense increase in their history. So the devil's in the details. And so we need more information on revenues, returns, and key performance indicators for all this spending. So we have one of the low estimates on the street for the year for J.P. Morgan. And then for Morgan Stanley, the transformation with their deals, E-Trade, the engagement has really fallen off. And with Eaton Vance, kind of a bond house, bond fund outflows have been happening for the industry as a whole. So we think J.P. Morgan and Morgan Stanley don't look as good as investors think they do. So we would prefer being with the likes of a Bank America.
Because you like the whole the mainstream banking theme better, given the weakness in the markets?
Absolutely. Look, you have Wall Street banking headwinds, Main Street banking tailwinds, and we think Bank of America is a better play on that Main Street banking theme, especially with the Wall Street headwinds being a bit more than we think consensus expects.
You also like the regionals on that theme?
Yeah, we do. The regionals have sold off big. Look, in the first quarter, we think equity will get hurt from securities losses. The banking industry has $6 trillion of securities, so don't think there aren't losses. And all that means is book value might not grow or it might go down. But after the first quarter, you start to have the best Main Street banking growth since 1984. And I just don't think people appreciate the magnitude of not only the top line, but especially the bottom line, as the tech revolution of banks allows more of every dollar of revenue to fall to the bottom line. So, yes, regionals like U.S. Bancorp or Truist.
Or Truist. So can you just clarify how the shape of the yield curve influences the financials? Because we have seen interest rates rise, and we know the Fed is going to keep raising rates, and all of that should be good for banks. But then you've got this inversion in many key parts of the curve, which typically signals recession. So how does that all add up for the performance of financials?
Well, the stocks are being hurt by the sentiment. You had the 2 10-year spread actually turn negative the last couple of days. And so people are saying recession, recession, recession. I'm telling you from a bottom-up perspective, I don't see it, but that's the concern out there. And the logic is Fed rate hike, slowing economy, recession, sell cyclicals, bankers cyclical, therefore sell banks. And I get it. It's like a Pavlovian dog effect or something, but I think that's wrong if you look out over the next year, because I think credit quality will be better than people expect. Even if you had a recession, you just started having loan growth the middle of last year. Even if you had a recession, you won't have big losses. And then you get this amazing, Main Street banking tailwind and expense control. Banks should grow revenues faster than expenses. This is the moment for banks. Now, it might be the opposite of other earnings seasons. If banks have sold off, and now maybe they recover once banks report. And the past earnings seasons, you've seen, banks get bid up only to sell off.
True, the setup.
First quarter might be the opposite of prior earnings seasons.
Mike Mayo, thank you very much for jumping on the phone with these new calls, taking down the price target of JPM to 150 from 180.